Most people spend decades earning money without understanding what it actually is, not the definition they teach in school, or more often skip entirely. The real mechanism, the one that decides whether you struggle or sleep peacefully at night. The money sitting in your account right now has no real value built into it. It only works because everyone agrees it works. And the system that controls that agreement was designed to keep you working without ever understanding what you're actually working for. This system isn't explained because it benefits from your confusion. You've been playing a game where the rules were written before you were born. When asked to define money, most people call it a tool for exchange. That's technically true, but it misses the mechanism. Money is simply trust. It's an agreement that paper or digital numbers hold value. Currencies like the dollar have no built-in worth. Their value depends entirely on everyone believing they have value. This is the first layer of the illusion. When you get a salary, you're not getting wealth, you're getting a claim on wealth. It's a promise. If belief in that promise breaks, the value disappears. The system only works because everyone agrees it does. Over time, banking systems grew up around this trust. These institutions run on layers of complexity that can feel impossible to understand. This works in their favor. Most people use money without questioning what it is. When they run out, they assume the failure is entirely personal, but often the pressure is structural. When you deposit money, the bank doesn't just hold it, it loans it out. This is called fractional reserve banking. Banks act like a multiplication machine. They keep only a small portion of deposits in reserve. When a bank gives out a loan, it basically creates new money digitally. Most money in circulation today isn't physical cash, it's debt that someone owes to a bank. Here's how this works in practice. You deposit $10,000. The bank keeps $1,000 in reserve and loans out $9,000 to someone buying a car. That person writes a check to the dealer. The dealer deposits it in their bank. That bank keeps $900 in reserve and loans out $8,100. This process repeats. Your original $10,000 deposit has now created over $50,000 in the economy through loans. But none of that new money is real the way you think it is. It only exists as long as people keep making payments. If 3 people in that chain default, thousands of dollars just vanish. Your savings didn't go anywhere, but the system that gave them buying power just got smaller. This means your salary and savings exist largely because someone else is paying interest on a loan. If everyone paid off their debts tomorrow, most of the money supply would disappear. This structure needs constant growth to survive. Every loan has interest attached. If a bank creates $1 million, the economy now owes $1 million plus interest. The money to pay the interest doesn't exist yet. It has to be created through new loans. This cycle demands non-stop expansion. The system rewards debt because debt fuels this growth. It's often more comfortable to feel rich while in debt than to feel poor being free. The economy is built to make this state normal. Average household debt loads have hit historic highs. National deficits climb automatically. Most people see their debt as a sign of personal failure. They think they're just bad with money. In reality, they're navigating a system that needs their debt to function. The structure of repayment makes this trap permanent. A credit card balance of $5,000 at 18% interest with minimum payments takes over 30 years to clear. You'll pay more than $8,000 in interest alone. The minimum payment is carefully calculated to keep you paying as long as possible while feeling like you're making progress. Most of that early payment goes to interest. The balance barely moves. This isn't an accident. The longer you pay, the more the system extracts. And because the payment feels manageable, you rarely see the total cost until years have gone by. Changing your position starts with seeing the mechanism clearly. You can't just opt out of the economy. but the system uses psychological hooks to keep you engaged in specific ways. Money has shifted from a survival tool to a status signal. You're encouraged to show success through buying things. Expensive homes, vehicles, and devices signal your position in the hierarchy. This desire isn't accidental. It's reinforced by every screen you look at. The system lets you get these signals before you can afford them. Debt acts like a way to pull spending forward in time. You feel successful today, but you pay for it with future work. This creates a specific trap. While paying off debt, you can't take risks. You can't leave a stable job. You can't easily start a business. You're locked in by your obligations. What you're actually trading isn't money, it's time. Every monthly payment represents hours you have to work in the future. A car payment of $400 might represent 30 hours of work each month. Over 5 years, that's 1,800 hours. If those hours were spent building something you owned instead of paying off debt, the outcome would stack up differently. But the system makes the monthly payment feel small. It hides the total time cost. This is how obligations quietly eat up decades. Financial products often include fees and complexity that make them hard to compare. High rates and minimum payments are built to stretch out the repayment period indefinitely. Complexity acts as a wall. When the rules aren't clear, people blame themselves for losing. This self-blame stops them from questioning the structure itself. The system depends on you believing that financial stress is a personal failure. If you understood that your struggle is a math problem created by how the system is built, you'd stop blaming your discipline and start questioning the game. But blame gets redirected inward through language. You hear about financial literacy and personal responsibility. These ideas assume the system is neutral and you just need better skills. This is partly true. Skills do matter, but skills can't overcome a structure designed to keep you moving without building real momentum. The system benefits when you focus on fixing your behavior instead of recognizing that the rules themselves create the outcome. Those who understand the system use debt differently. They treat it as a tool rather than a way to buy things. When most people borrow, they buy things that lose value, like cars or vacations. Their debt goes up, but their assets stay flat. When wealthy people borrow, they invest. They buy property, businesses, or stocks. Their debt goes up, but their assets go up faster. Here's the difference in practice. A person borrows $30,000 to buy a car. The car loses value right away. In 5 years, it's worth $12,000. They paid $8,000 in interest. Their final result is negative $26,000. Another person borrows $30,000 to invest in something that grows 6% each year. In 5 years, that asset is worth $40,000. They paid the same $8,000 in interest. Their final result is positive $2,000. Same amount borrowed, same interest rate, opposite outcome. One path ate up future income, the other built future capacity. Tax codes often favor this approach. Interest on business debt is often tax deductible. One group pays interest with after-tax income, the other uses debt to lower their tax bill. The tool is the same, but how you use it creates opposite results. One path limits freedom, the other creates leverage. Compound interest works in two directions. It works against the borrower and for the investor. If you invest consistently, time multiplies your money. But this needs extra cash. The system keeps most people too busy paying off past spending to build that extra. Generational wealth often provides the starting capital to skip the early struggle. By the time a wealthy person is 30, their assets are often creating their income. The average worker is often just getting stable in their 50s. The math isn't neutral. Understanding this doesn't instantly remove your debt, but it removes the shame. You stop blaming your character for the math outcome of the system you live in. Once you see the game, you can adjust your strategy. You can decide not to signal wealth you don't have. You can refuse to trade future work for present comfort.
You can't leave the system, but you can change how you interact with it. You can build a life where money works as a resource rather than a constraint. That shift in perspective is the beginning of leverage. Now that the mechanism is visible, the system responds to behavior. What you do with this clarity is up to you.